The Australian Financial Review.
Australia's compulsory superannuation system is a global success story. It's now the world's fourth largest pool of pension savings, worth $4.2 trillion. But it's also a honeypot for risky investments.
The sharks are circling, and they can't wait to exploit the fact that many of us need as much help as we can get when it comes to managing our retirement funds.
And over the past 18 months, 12,000 Australians have invested their life savings into 3 super schemes, attracted by the promise of 10% plus returns. Shield's Master Fund, First Guardian and Australian Fiduciaries sucked in $1.2 billion in super money and spent it on risky, illiquid property developments. Now that money is mostly gone, thousands of people have lost their retirement savings and they're furious with fund managers, regulators and the government.
I reckon this is the biggest con job since Storm Financial 15 years ago.
The whole mess is really a test case for the $85 billion superannuation platform industry and the duty of care that the trustees owe to their investors.
Welcome to The Fin. I'm Alex Gow, the producer of the show, in this week for Lisa Murray. Today, wealth reporter Andrew Hobbs and columnist Tony Boyd on what happened, how some of the biggest names in finance lent their brands to these toxic products, and what needs to change to stop it happening again. It's Thursday, October 9. Andrew Hobbs, Tony Boyd, thanks for coming on.
Well, thanks for having us.
Thanks for having us. It's really fun to be here.
So, Andrew, you've been talking to a lot of investors caught up in these 3 schemes, including 2 that we'll hear from shortly, Chris Johnston in the left speaker, Neil Miller in the right. Now, these investors all seem to find these products in the same way. So tell me, how did they get caught up in it?
Yeah, sure. It basically started with a Google search. They'd use a search like Compare Your Super or something like that. A lot of these sites were called things like that to find out whether there was something better out there.
I was looking at superannuation or something, and it was like an ad for comparing what value your super is or whatever. And
first, it started off with the lead generators. Let's call them the comparison site. You know, they cold called me out of the blue. Hey, we can give you, a summary of where you're at and where you can be and all that sort of stuff.
They'd enter their email, their phone number, a few financial details. And pretty much straight away, they'd get a phone call.
And that they'll obviously tell you all the good stuff.
Well, they were very aggressive, right? They were pretty blunt.
And that caller, when they spoke to them, would quickly point them in the direction of an investment that promised double-digit returns.
Right.
They said it would definitely perform more than the retail funds, and it'd be at least 10% or better.
They come back to me with a summary of, hey, this is what we can do, this is what we can do. And it was only basically, and in hindsight, there was only really one offer.
That was usually pitched about 2 or 3% higher than the returns that they were getting in their retail or industry super fund.
You know, we've become conditioned as Australians to have these 2 different types of superannuation offerings compared, and everyone knows the ad with the 2 people on the escalators, and one's certainly going faster than the other. And, of course, we then think, well, how do I get a better return in my super?
Compare the pair. Same age, same income, same super contribution.
So there's an accepted wisdom that you can always do better by going somewhere else.
Yeah, the thing is, though, that person that they spoke to, it's not a financial advisor.
Yep.
They're basically a salesperson. In this instance, we'll call them lead generators. They're the first link in the chain that basically pulled these people into a world of pain. These lead generators are paid by financial advisors, and in many cases they were related to the financial advisor, but none of that needed to be disclosed. So the lead generator would refer them to a financial advisor.
They then put me on to the financial advisor. You sign here and we'll do all the paperwork for you and transfer it, and it'll be all happy days. Go from there, you're going to pick up all this extra interest and all this extra money, and you'll be so much better off.
That financial advisor would convince the investor to either transfer their money straight away into a product via a new superannuation platform, or set up a self-managed fund in order to invest in this new product.
He said, I'm such and such's boss. I was just ringing to say you're having second thoughts about investing, and then he just did the big sell. And so eventually I said, oh, okay, all right, well, okay, I'll continue with it.
Normally, a financial advisor would take weeks to give someone financial advice.
Right.
In this process, it was hours at best.
So much money was gathered in this way that it's quite extraordinary. In 2023, in a very short space of time, the amount of money in the Shield Master Fund went from $50 million to $400 million. And this obviously set off some red flags among different so-called gatekeepers. And of course, ASIC froze the funds, which started what you might call a catastrophic outcome for those investors.
I had $530,000, including the interest that was earned in that period, basically written down to $1,800 overnight. They spent it on cars and women and coke and all that sort of shit, so it's all gone out the window.
Right. And Tony, how many people invested in these three schemes?
We're talking 12,000 people, and we're talking about $1.2 billion. I mean,
okay,
I reckon this is the biggest con job since Storm Financial 15 years ago.
Mm. So, Tony, two of these schemes, Shield and First Guardian, were new funds and they had no track record. So, what did people think they were investing in, and where did their money actually go?
In every case, it was described as a diversified, regular superannuation fund.
Right.
It had balanced options, conservative, growth options, and behind all that were a product disclosure statement that described all this. So, in a sense, they were operating within the laws as laid down by the Australian government and the Australian Securities and Investment Commission. But of course, that wasn't actually the case. When they all went bust, the money was found to have gone into all sorts of very highly risky, illiquid investments.
Got it. So tell me about a few of these projects.
For example, in Shield, they put $100 million into a 5-star luxury hotel development in North Queensland at 75 Port Douglas Road. But this is absolutely stunning to hear that they did this without a surveyor report or a development approval from the local council.
Mm.
There's really nothing there now. It's a vacant site, and according to an independent value, that'll cost about $250 million to develop. I don't think that's going to happen. In First Guardian, there was $200 million loan to a company in Singapore. Those loans will never be recovered, I don't think.
Right.
It was transferred out of accounts there, and I'm not sure where it went. I don't even know the liquidators know where it went. In Australian Fiduciaries, they invested $160 million in what was supposed to be ethically managed portfolio of shares and other assets, including an NDIS property. But the liquidators say it's impossible to assess those values. I think all that money's gone as well.
And that's the main concern for the people at the heart of this debacle, the investors who put their money into these funds.
The worst part of it was, you're sitting here fat, dumb and happy, hoping everything's all right.
When I started bringing people up about this story, when I was asked to start looking into it a few months ago, it was really quite emotional.
And then that email came saying that the company was in administration, and that's when I got really worried. And then 2 days later, my wife died from cancer. So, yeah, it was just a bad time. It was the year, October last year.
There were nurses, retirees, builders, care workers. All of them are basically heartbroken by it. But the money's just part of it. The toll on people's mental health is also extreme.
The whole period since even then, the mental health strain that goes on you, and just the thinking of it non-stop and what am I going to do? And I was so embarrassed at the first part. I didn't tell my wife probably for about a week.
These people were let down every step of the way. From the moment they went to that comparison site, they were essentially trapped.
Yeah, and so the machine was in motion and these investors were caught in its momentum, but technically there was meant to be a chain of gatekeepers every step of the way looking out for them. And those gatekeepers include the financial advisors, the research houses, the auditors, and the super trustees. So where were they?
So the financial advisors and everyone were missing in action here. We sent the Shield and First Guardian product disclosure statements, which the industry jargon for that is PDS. And we sent it to 2 independent financial advisors. And within minutes, they found errors really on every page. The most problematic one to start with was the contradictory claims about what the funds apparently invested in and what they actually invested in, as Tony was saying earlier. Another issue was the clear conflict of interest. The managers of these funds were also the responsible entities. They were also getting paid internally and then not disclosing that fee to the customers. Also in the First Guardian PDS, for example, it discloses at the very end of the statement in the risks section of the PDS, that a significant proportion of the assets would be in illiquid property. That's a signal of a very high-risk investment that many professional investors wouldn't make.
Right.
And how an advisor could think it was suitable for a 50-year-old nurse. It's just extraordinary. Also, most of the money invested in Shield and First Guardian came through a small number of advisors, raising a red flag with the regulator. Also, the financial advisors were getting kickbacks from putting investors into Shield and First Guardian. Legally, that's supposed to be banned, but there aren't restrictions on payments made to lead generators, and because of the relationship between the advisors and the lead generators, they were able to get around it. Advisors are required by law to have their clients' best interests at heart. It's hard to see how the advisors that put their clients into these funds actually did that.
Of course, the advisors were able to rely on the research done by independent research houses, and there's about half a dozen of those in Australia. The one in particular that rated Shield and First Guardian, SQM Research, gave them 3 3/4 star ratings, which is a favourable rating. It's regarded as investment grade and suitable for someone who wanted a diversified mix of assets. But SQM itself discovered that what was described in the product disclosure statement was not actually in the portfolios that were being invested by the managers of these funds. And they themselves suspended their ratings on these 2 products. But of course, by that time, the horses had bolted.
And how do these guys, the research houses, how do they get paid?
SQM and other ratings houses, they get paid to rate these funds.
Right.
And they get paid by the funds themselves.
It is another conflict of interest, obviously, in the whole chain of conflicts that are evident in this whole disaster.
And there's another big player here that's also meant to be keeping watch, doing some due diligence on behalf of the investors.
That's right. The superannuation wrap platforms, which themselves act as trustees. In this case, we had Macquarie, we had Equity Trustees, we had Diversa, we had Net Wealth. And the one that, caught my attention the most was Macquarie, because one of the financial advisors, who was one of the largest promoters of Shield, told me, look, Macquarie gave it all the credibility that was needed, and that just pulled in more money.
Yeah, so let's talk about super platforms. As people get close to retirement, they might hire a financial advisor, and most advisors will use a platform to invest their money. Platforms are usually described as being a bit like a supermarket with lots of different investment products on their shelves. And most of the money that was invested in Shield and First Guardian was invested via a platform. So tell me, Andrew, how hard is it to get a product onto one of these platforms?
Well, based on court documents, it took 1 meeting and 3 emails. That's all it took for Macquarie to put Shield on its platform.
Mm-hmm.
Essentially, the 2 promoters of Shield, they had a meeting with Macquarie, and then 3 months later, Macquarie opened Shield to investors on its wrap as one of its 700 products on that wrap. Interestingly, Macquarie employed a consultant to review the fund's PDS in that time. That consultant raised 14 red flags with Macquarie, but Macquarie went ahead anyway.
But when I first rang Macquarie and Equity Trustees in April, when I wrote a column about this, they didn't really want to be quoted, but they certainly gave me the impression that they thought the system would grind to a halt if they had to do due diligence on the hundreds and hundreds of products on their super trustee platforms. I mean, how could they possibly check them all? But as ASIC Deputy Chair Sarah Court said to me, they do have an obligation under the Corporations Act and under the superannuation laws to do the checks that are required to protect the investors.
Yeah, we don't want to make it all about Macquarie. I mean, Equity Trustees only took a couple of weeks to approve Shield. In that process, a junior analyst actually questioned it, but again, Equity Trustees went ahead and put it on the platform. but it required investors to limit their investment to 50% of their total investment. That limit lasted a few days. It was raised to 95% when one financial advisor complained, and that request to increase the investment limit to 95% was met with the phrase easy peasy by an executive general manager at Equity Trustees.
I think the wrap platforms think of themselves as supermarkets offering a range of different products, and the choice of those is allegedly guided by the financial advisor. But of course, we know that the financial advisors in this case were heavily influenced by all sorts of conflicts. But the trustees themselves have to really provide some protection for anyone going into those supermarkets and picking up a product. You can't have a toxic product on the shelves of Woolies or Coles. It's illegal. And the same is true of trustees of these big platforms offering products to consumers who are really trying to preserve and grow their life savings.
Andrew, Tony, we've been talking about how the big names in Australian finance got caught up in these superannuation schemes. And in late August, ASIC really shocked the market by launching a case against equity trustees for failing to conduct enough due diligence on Shield. And just earlier this month, there was some more big news.
Today, ASIC took action against Macquarie Group again for promoting the failed Shield Master Fund on its investment platform.
Macquarie did a deal with the regulators and agreed to pay $320 million to compensate almost 3,000 investors. Tony, why did it do that, and what does it mean for the other platforms?
Well, I thought it was a very smart move by Macquarie. They got the regulator off their back, they showed accountability for their mistakes, and lo and behold, they admitted they had not acted efficiently, honestly and fairly by failing to place Shield on a watch list for heightened monitoring. And, of course, what they did had enormous implications for equity trustees. They're being sued in the courts under both the Corporations Act and the superannuation laws. And I would say that I'm not sure they can afford to settle. I looked at their balance sheet and they got $150 million in cash.
Right.
And the liability that we're talking about here is about $160 million. Now, in Macquarie's case, they will recover some money from the liquidation process, but basically, equity trustees, they deny any wrongdoing and they're fighting it as hard as they can. The question I have is, what does it say about the morals of the organisation when another major superannuation wrap platform has found it much better to actually settle?
And what about other platforms like Netwealth and Diversa?
Netwealth is the only one of the trustees that's come out and said publicly that First Guardian is a fraud. Now, it's not doing that really to help investors. It's doing that to make the legal case that it's not to blame. It's arguing essentially by saying that it was defrauded in the same way that the investors were.
Where does that leave investors?
Well, it leaves them waiting, basically. It leaves them with nothing. It leaves them with the liquidators.
Okay.
I have tried to find out from ASIC the progress of their case against equity trustees, and they realistically think that this could take 18 months to 2 years. They won't even be in the courts till maybe June next year for a hearing. So it's quite a lengthy process that drags the chain for these people who are staring at the loss of their life savings.
Yeah, so just without the ASIC legal cases, they can also take their complaint to the Australian Financial Complaints Authority for compensation from investors. And there's something called the Compensation Scheme of Last Resort. That process, though, could take as long as 10 years for some of the investors that I've spoken to.
And to emphasise the point, these investors, lots of them are retirees without, decades to recover those funds. So let's focus on the regulator. Where was ASIC? Was it too slow to intervene here?
Look, it's a mixed report, really, for ASIC in this.
Right.
Maybe with Shield, they acted in a reasonable time. But for First Guardian, there's a 9-month gap between when First Guardian stopped allowing redemptions from the fund and when ASIC actually froze the fund. That meant 9 months of people's life savings kept going into it.
In terms of the enforcement action, I think ASIC has had a pretty good response. In essence, they've probably got the biggest enforcement action since Alan Bond was chased down in the 1990s. We're talking about 25 separate legal cases, 40 investigators working on this, and there's still no decision being made about whether or not they go after the promoters, because their first priority is getting the money back for investors.
Okay, so it really does seem that at every moment in the chain of money coming in from investors into these schemes, people were looking the other way and blaming someone else. So what reforms needed to prevent this happening again?
Well, to start with, there should be some reform around lead generation. In essence, lead generators are entirely unregulated. They're not bound by any obligation to anyone. They're pure salespeople. So they need to crack down on lead generation in some way. If something like this were to happen again, we really need to look hard at the efficiency of the compensation process. The current process is really hard, really slow, and hard to understand.
I think one of the things that's crying out for reform is managed investment schemes. The ASIC chair, Joe Longo, has given some good speeches on this and spoken to the parliamentary committees about it. Basically, he says there is no friction between someone moving their money out of an industry super fund into a dodgy managed investment scheme. And there's 3,600 managed investment schemes. And as he said, if the fund has a valid trust deed and a disclosure document, ASIC has to register it. I mean, it could have as its underlying assets alpacas or meme coins. It doesn't matter. They have to register it. And once that happens, they could then issue a product disclosure statement, and off we go again.
So finally, after 33 years of mandatory super, the baby boomers are aging and there's going to be a huge amount of wealth up for grabs. The super honeypot is going to be a target, and that leads me to the question, and I'd like you both to respond, is there just some inevitability that this will happen again?
It doesn't inevitably have to happen again if people are able to look more closely at who's giving them advice. What is the product that they've got? Were they led into it through some sort of compare the pair site on Google? It's a very different kettle of fish to transfer your money from an industry super fund with a diversified array of assets earning about 9 or 10% a year into something that is a managed investment scheme with one single promoter who's filling all these conflicted roles. And I think that's the lesson, that if there's a lesson in financial literacy to come out of this, there is actually a pretty good functioning superannuation system. We're talking about financial assets of about 0.3% of the 4.2 trillion that is in super in Australia. It is obviously incredibly heart-wrenching and financially disastrous for a lot of people who are caught up in this. But overall, the system does seem to be working.
One of the tragedies of this is how it's turned people off financial advice. I've had 2 or 3 people say to me, "Oh, look, what I've learned out of all this is never trust a financial advisor," which is exactly the wrong lesson they should have learned. There are a lot of really good advisors out there who do have their clients' best interests at heart. Bearing in mind that there's going to be billions handed over from baby boomers to their children, this pot of money will only become more attractive to scammers, which paradoxically makes the case for stronger financial advice, greater financial literacy, and braver regulators.
Thanks for listening to The Fin. I'm Alex Gow with wealth reporter Andrew Hobbs and columnist Tony Boyd today. The Fin is produced by me and Mandy Coolin. If you like the show and want to hear more, follow us wherever you get your podcasts. And consider rating and reviewing us, as it helps others find us. For more stories about markets, business and power, subscribe to The Financial Review at afr.com/subscribe. Lisa Murray will be back next week.
The Australian Financial Review.